A major storm is hitting the Malaysian business landscape in 2026, and the safety of outsourced, glossy sustainability reports will not keep you dry. The National Sustainability Reporting Framework, or NSRF, shifts ESG from an optional public relations exercise into a mandatory financial disclosure. This includes the implementation of the carbon tax, charging heavy emitters 15 ringgit for every ton of carbon equivalent they produce. This comparison matrix highlights the shift. Old ESG relied on simple checkboxes, but 2026 mandates require precise data on Scope 3 supply chains and the 15 ringgit carbon tax. Handing regulators a marketing document now triggers an audit failure. You need audit-ready verification. This leaves companies a difficult choice: pay external consultants a premium every year for audits, or build an internal data system to manage it themselves. Surviving these mandates requires a shift from purchasing external reports to licensing your own people, training internal staff to capture and certify the data. The Sustainability Integration Model, or SIM, delivers a complete operational overhaul through its training and reporting packages. At the entry level, specifically levels 1 and 2, your team commits to 10 CPD training hours and manages basic personal or household ESG data entry. This scorecard shows the direct return on that time. 10 hours of training connects directly to SME CARP grant eligibility. This established carbon baseline satisfies the mandatory criteria for the 50,000 ringgit SME Corp ESG grant. However, relying solely on this entry-level tier creates a significant operational gap. Large corporate clients will reject this basic data for their mandatory Scope 3 reporting, as it lacks the depth required for high-level supply chain integration. The micro tier serves as an effective survival tool for grant seekers, but it is a dead end for any business relying on integration with larger corporate partners. Level 3 acts as the battleground tier for Tier 1 SMEs who supply larger corporate clients. The operational requirement is 30 CPD hours dedicated to certifying a single staff member as an official ESG reporting personnel. This certified individual then oversees 10 of the company's own sub-vendors as they complete their own ESG self-reports. The scorecard illustrates the payoff for this extra effort. Vetting your own vendors secures your preferred supplier status. Proving this supply chain readiness is what maintains contracts with giants like Petronas or FGV, who need your data to satisfy their own Scope 3 disclosures. This puts you in a difficult position as a regulatory enforcer, potentially causing friction with small partners who lack the capacity to track their own carbon metrics. Level 3 effectively turns an SME into a regulatory shield for their larger clients, absorbing the compliance burden to keep the revenue flowing. Mid-tier and enterprise organizations facing immediate financial exposure from the 2026 rules require the depth of levels 4 and 5. This requires a massive commitment: 200 CPD hours to train a lead controller under the strict ISO 17024 standard. It also creates a total reliance on the proprietary Dignity Ledger software for the entire ecosystem's data management. The scorecard for this tier links your ISO controller to two major outcomes: carbon tax offsets and high-level recognition via the MGSA or APSCA awards. This generates a fully audited carbon accounting portfolio, providing a literal shield against your 2026 carbon tax liabilities. However, this creates a major vulnerability. Only one certified key person holds the authority to mint this data. Level 5 provides bulletproof regulatory defense and regional branding, but it centralizes your entire ESG authority into a single human point of failure. These bundles function as a software licensing and human capital credentialing system. If your goal is simply to have a few green metrics for a public relations campaign, this is the wrong system for you. Adopting the P5 framework and ISO requirements represents extreme financial overkill for simple website PR. This segmentation quadrant maps the exact path for organizations that must navigate the 2026 mandates. Let's look at the micro SME path. Level 2 belongs exclusively in the lower left quadrant. It is for startups whose primary goal is the SME Corp ESG grant. Tier 1 suppliers face a different set of requirements. Level 3 sits in the center for supply chain defense. This is for the Tier 1 supplier whose contracts depend on satisfying Scope 3 mandates. Finally, the enterprise scale solution. Level 5 occupies the top right. It is strictly for enterprise entities facing substantial carbon tax exposure who require an impenetrable ISO-certified paper trail. The 2026 deadline constitutes an immediate operational reality for Malaysian boards. This framework presents a simple choice: pay the government in compounding carbon taxes or pay upfront to build an internal regulatory moat.